Can non-residents offset Canadian rental losses against other Canadian income? For many non-residents who own rental property in Canada, the early years of ownership often mean high expenses and low income, or even a net loss. Renovations, mortgage interest, property taxes, and management costs can quickly outweigh rental earnings. The question is, can you use those rental losses to reduce other Canadian income and pay less tax overall? The answer is yes, but only under specific conditions. Let's look at how the Canada Revenue Agency, CRA, handles this situation. Rental losses must be legitimate. First, your rental loss must come from a genuine rental activity, not personal use. If your property is rented at fair market value, FMV, and operated with a profit motive, the CRA recognizes it as a legitimate rental business. You can then deduct expenses like mortgage interest, property taxes, insurance, maintenance and repairs, utilities, management fees. If, however, the property is rented to relatives at below market rent or used personally part of the year, the CRA may deny or limit loss deductions. Losses can offset other Canadian source income. Once verified, rental losses can offset other Canadian source income, but only in specific contexts. If you earn other income in Canada, for example, business income, employment income, or investment returns, you can use the loss to reduce your taxable income in that same year. Example, you have $10,000 in rental losses and $30,000 in other taxable Canadian income. Your taxable income becomes $20,000. This helps reduce your overall Canadian tax burden. Section 216 filing required. To use the loss properly, you must file under Section 216 of the Income Tax Act. Without this election, your rental income and loss remains subject to the 25% gross withholding rule, and you lose the ability to deduct expenses or claim offsets. Section 216 effectively converts your rental activity into a regular income tax calculation, allowing you to apply deductions and losses just like a resident taxpayer. Loss carryforward rules. If your rental loss exceeds your total Canadian income for the year, the CRA allows you to carry the unused portion forward to future years. This means you can use your losses to offset future rental profits when your property becomes more profitable. It's a smart strategy for new property owners who face big expenses in the first few years. Losses cannot offset foreign income. Here's the catch. Rental losses in Canada cannot be used to offset foreign income earned outside of Canada. For instance, if you live in the US and earn employment income there, your Canadian rental loss can't reduce your US taxes, though you might be able to claim a credit for taxes paid in Canada under your country's tax treaty. The takeaway: non-residents can absolutely use rental losses to reduce other Canadian income, but only if they file properly under Section 216, report all income sources accurately, and keep thorough records to prove their expenses. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.